Hi there, I'm champion trader Kevin Davey, and today I'd like to talk to you about diversification in your algo trading. Can it be a bad thing? Well, let's find out. All right, so if you've followed me for any period of time, you know that I am a big, in capital letters, big fan of diversification. Why? Well, the closest thing I've ever seen to the trading holy grail, that mythical way that you never lose and everything is great. That's the holy grail. This is the closest thing to it. And it's not perfect by any means, but it's pretty good. Diversification is pretty good. At the same time, though, it does have disadvantages. And I think it's important for you to understand those. You're not getting something for nothing with diversification. You are potentially giving up something. So let's talk about it. Well, first, you might say, well, why? Why do you even do multiple strategies? Well, Harry Markowitz, he won a Nobel Prize for it. They didn't give it to him until 1990. I think he did his original work in the 50s. He did it with the stock market. And he said, hey, if you have a diversified portfolio, you're bound to do better, return wise or return to risk wise. And with futures are perfectly set up to do good diversification because you have all these different sectors. You have stock indices, currencies, interest rates, metals, energies, ags, softs, and they all act different at times. Sometimes they all sort of act the same, but a lot of times, hey, the price of gold isn't really going to affect the price of cotton, for example. At least not usually. So, by being in all these different markets, you can get diversification, which helps give you a smoother equity curve. So, that's the idea behind diversification. Here's how it looks. These are strategies I give out in my Strategy Factory workshop. I give away 8 strategies in the gold package. I give 8 more in the platinum package. But you can see the curves towards the bottom are the 8 that I give away. And, they're all sort of up and to the right. The one has kind of been struggling. It's been going down. They all have different amounts of success. But when you add them together, you get this dark green line. And look at that. That's pretty good. And you get that from a couple stock indices. There's a metals, there's an energies, there's an ag, there's another energy, there's an interest rate. So it's a wide array of different markets. And you trade them together and you get that nice looking equity curve. Okay, and you say, well, hey, that's kind of neat, but what if I were just to trade one of the best performers here? Couldn't I do better? Well, the answer is yes. Here's an NQ strategy, the mini NASDAQ. In the previous chart, I traded 2 of the MNQ. And so here, I'm going to trade 10 times as much because, hey, I'm not trading a portfolio. I can afford to trade bigger size, right, with probably the same account, roughly. And look at that. You can make a lot more money trading this one strategy than you could trading that diversified portfolio. So if you started with the same amount of equity in both cases, you could get a much better return. Now, the downside to it is, hey, you have these kind of sharp drawdowns, you have this long protracted period, but over time, you might decide that, hey, maybe this is worth, more than almost, let's see, it's probably about double, close to double the profit. Maybe that's worth that extra risk with those extra drawdowns. So you might say, hey, diversification, not so great. I'd rather have more profit. Okay. And that's a drawback of diversification. But the big thing is you didn't know in advance that NQ strategy was going to do so good. What if that NQ strategy had failed and you were only trading that? Well, you're probably going to get wiped out. So when you trade one strategy, yeah, if it does really well, your upside way up there. Probably way more than you can get with a diversified portfolio. But with that one strategy, your downside could be worse if that strategy fails. If this NQ strategy failed when it was in a portfolio, yeah, it would hurt, but it wouldn't ruin the equity curve, the overall equity curve. So that's how to think about trading multiple strategies. If you know you have the world's greatest strategy and you know it's going to work for the next 1, 2, 5 years, whatever, I say just go and trade that one. Trade it with as much size as you can handle, and you're going to do really well. But remember what I said at the beginning of this, that if you know it's going to perform well in the future. Who knows that? I certainly don't. I don't think you do either. No, the fact is nobody knows what strategy or if any strategy will perform well in the future. So that's the thing to keep in mind. If it fails, you're out. So by trading multiple strategies, you can see some don't do so well at certain times, but overall, the other ones make up for it. So even though in this chart, the pink one is not doing so well the past few months, overall, I'm still doing pretty good. So diversification helps. But, like I said, it can be bad if you have one great strategy, then you're going to be leaving money on the table. So remember that. Upside performance can be more by trading, and you get a smoother equity curve and less risk of disaster. You give up performance, but you're less likely to blow out your account. I hope that helped explain one of the drawbacks of diversification. I hope you enjoyed this video. I'm Kevin Davey. Have a great day.